Hey there YouTube. So in this video I wanted to briefly cover personal holding company taxes for C Corps and how this information and the taxes computed and reported on your annual Form 1120. So briefly, what is a PHC or personal holding company? You can find the definition in Section 542 of the Internal Revenue Code. A PHC it's a C Corp where at least 60% of the income is what the tax code defines as personal holding company income, and so it's a two-part test, and at any time during the last half of the year, more than half of the stock is owned by not more than 5 people, right? So PHCI, it comprises a number of different things, but the most common types of PHCI that you're going to see are portfolio income. So if you got a C Corp that's generating a lot of interest, dividends, capital gains, basically kind of looks like an investment fund or a hedge fund. That's definitely PHCI. And then the other more common one is personal service contracts. So personal service contracts, basically you're engaged to perform a contract for a customer and you're being named personally, right? You're the actual one that's doing the work, but under the terms of the deal you have the money being pushed into a C Corp rather than paid to you personally. That's what the PHC is really trying to get around, is preventing people from funneling types of portfolio income or personal service income into a C Corp to try to get, either a lower tax rate or defer some income taxes. So that's why they have these PHC rules in place, right? So the tax is a 20% tax imposed on the undistributed income. And again, the aim here is to try to tax certain types of income at what the IRS deems to be the maximum rate. They don't like shareholders deferring taxes, and so they have this PHC tax in place to try to kind of force you, basically forcing your hand to distribute dividends out to the shareholders if you have this type of PHCI generated in the company. Right, so personal service contracts, that's the one I'm going to focus on here, and we'll look at an example. It's defined in Treasury Reg 1.543-1. So an example of this, a corporation enters a contract to perform personal services for a customer, and the customer designates the individual shareholder as the one that's doing the work, right? So legally on paper, it looks like the corporation is performing the service, but in all practicality, it's the shareholder, the person that owns the company, that is actually doing the project. Right, and so a very simple example here is an actor or actress, right, is hired to perform a role in a movie. They're the one that's actually doing the work, and again, the company that's hiring the actor to perform the role wants that specific person, right? So the actor has to actually be the one that's doing it. They can't just go hire somebody else and employ them as an employee of the corporation to perform that role. Right. So let's have a quick look at an example and see how this actually kind of works out on paper and on a tax return. Okay, so here we have a Form 1120 tax return. Remember, the personal holding company tax only applies to C Corps. So this is, if you have a corporate entity formed under state law, that's by default a corporation, so you haven't made an S election. Or you could also have an LLC that filed a C Corp election to be taxed as a C corporation rather than the default treatment. So in this one we have a personal holding company Inc. We've indicated here that it is a PHC, right? So you got to check box 2 there in section A here. And so in this one, we're going back to the actor example, right? So the actor was paid $200,000 for a role in a film. They paid themselves $55,000. That's their W-2 salary through this company. And they got some various expenses, right? They got some studio rent, advertising, other expenses. And so their taxable income in the corporation is the $132,000. Now, so for the 2020 tax year, the corporate tax rate was capped out at 21%. So obviously we're seeing a little bit more tax here than 21%, and that's because of the PHC. So the PHC tax is computed on Schedule PH here. Let's flip down here a bit. Schedule G, that's for John Q, right? Okay, so Schedule PH, U.S. Personal Holding Company Tax. So this form, relatively simple to fill out. I mean, you're entering the taxable income for the year, and you reduce, and remember, the PHC tax is on undistributed personal holding company income. So during the year, let me flip back to Schedule L actually. So Schedule L, the balance sheet, and then M1 and M2 here. So for the retained earnings reconciliation, that was the total income, right? The $132,000, the net income. And the taxpayer distributed a dividend of $25,000 during the year, right? So the $25,000 reduces retained earnings. It reduces the accumulated earnings in the company. So that's why this figure shows up again on the Schedule PH, right? So the amount of undistributed PHC income for the year is the $107,000. And in Part 2, we indicate what portion of the income is PHC income. In this case, we're treating it all as PHC income, right? So the whole $200,000 contract he received as PHC income. It's often the case where you might not have PHC income in the company. So, in this example, it's very simple, right? All of it is PHC income, but this might not always be the case, right? So be very careful filling out this form or this section of the form, because you don't want to treat all of the income as PHC income if it's not. And then very simply down here, Part 3, the tax on the undistributed income, right? So multiply line 13, that's up here, the $107,000 by 20%, and then you tack this number on to the standard 21% that's being calculated above. So again, very simple computation for the most part. But very important to get this right, because if the PHC tax is self-imposed, right? The IRS isn't going to send you a letter saying, hey, we think you have a PHC company, you might have to impose some additional tax on yourself. You have to be the one to do this analysis and compute the extra tax. And of course, if you are audited and the IRS determines that you should have been paying it and you weren't, you're looking at some interest and penalties. So hope that was helpful. If you have any questions about PHC taxes, or other corporate taxes generally, please leave me a comment below. Happy to answer those questions. And of course, always appreciate a like on the video, subscribe to the channel if you aren't already, and I hope to see you again soon. Thank you.